Next, another 30 seconds because Radha is also logging in her video. She has joined. She's facing some problem, and Ananya is joining.
Okay.
Just 30 seconds.
No problem. Perfect. That's okay. Thanks.
So Raghu, we are starting, and Radha is already here. Ananya is shining in a couple of moments. So,
Hi.
I'm here as well.
hi Ananya, welcome.
Hi Sharad. Hi Raghu.
Hi. Good evening.
Everybody, hi Ananya, hi Radha. Good afternoon.
Hi.
Good evening.
Good afternoon, everybody. I'm Shobhit Sinha, and on behalf of CII, I welcome you all to this virtual session on IPO market in India, corporate journey from private to public. As you know, CII provides a platform to its stakeholders for consensus building and networking on diverse issues. It is with this intent, CII, along with Unicus, is organizing this session. Before we start this session, I would quickly like to brief you on the genesis of organizing this virtual session. So, India's IPO market has bucked global trend by capturing a quarter of global IPO volume in the first half of 2024. The country now leads with approximately 5,500 main boards listed company. And equity markets are expected to stay dynamic and competitive due to strong growth prospect and better regulation. So today we have in this session, we have interesting mix of panelists from industry who needs no introduction. They are professionals with immense experience. We have with us Ms. Ananya Suneja, CFO Edelweiss Financial Services Limited. Welcome, Ananya.
Hi. Thank you, Shobhit.
Ms. Radha Kirthivasan, Head Listing and SME-BSE Limited. Mr. Mandeep Mehta, Group CFO, PB Fintech, Policy Bazaar. Mr. Sharad Chaturvedi, Partner with Unicus. And Mr. K. Raghuram, Partner with Unicus. Raghuram is also moderator for today's session. I would like to thank all the eminent panelists for joining today's discussion. And also, I would like to mention a special mention to Unicus for supporting this the event. And before I invite Raghu to moderate the session, I would like to request participants, if you have any question, please type your question in the chat box and address your question to a specific member, who will then pick up and answer as feasible, time permitting. Raghu, over to you. Welcome.
Thanks a lot, Shobhit. And good evening to all. With the markets touching new high every day, IPO has become the buzzword now, and the topic needs no introduction. Many private companies are aspiring to get listed in this market. There is a good robust growth in the Indian startup ecosystem as well, with over 100 unicorns, and this is set to further increase over the next few quarters. The government is also bringing up new regulations to attract foreign capital and provide opportunities to list in the IFSC GIFT City as well. We are also seeing a lot of activities through SEBI and MCA, and they are quite proactive, taking measures to strengthen the governance framework and oversight on the capital markets. Last year, we saw a record 75 listing in the main board, and this trend continues and expected to be beaten in the current year. But a lot goes actually behind the scene for a company to prepare and become a public listed company. From determining the objectives of the listing, timing, valuation, amounts to be raised, preparing the prospectus, conducting road shows, investor meet, and the list goes on. Post the listing, the life is equally challenging as there are a lot of regulations one needs to adhere to. With this background and context, let's start our discussion today with our esteemed panel members. And let me start off with you first, Ananya. Uh, in today's fast-paced financial world, companies face a lot of pressure to perform in the markets. As the company prepares for listing, what would be your advice? When is the right time to plan for any company to raise money from public markets?
Thank you, Raghu. Thanks for having me on the panel. And this is an interesting question in terms of timing, because most companies need to think through actually the strategy of treating the IPO not only as a financial milestone, but as a strategic decision. Okay. When I look at it, there are two reasons you need capital, and the whole thing is about the need, the question on the need. One is an easier question, which is very often the case where early investors are seeking an exit, and in that case it is almost the easiest and the de facto route is to go public, and it makes a lot of financial sense. But there is a set of companies that look at it from a need for capital, right? You're growing the business, organic growth, inorganic growth, or you have even a normal business development type of need that you have, right? And the question then is, do you need external capital to align with this, or do you need external capital in the form of equity to align with this? And that's the reason you go to the market, right? One of my experiences is that cost equity is sometimes seen as the easier way out. Cost of equity is normally seen as 0%, especially from just a purely financial planning P&L view. It has no cost vis-a-vis debt, which is the other thing that you can borrow, but that has a cost of capital, right? So if you look at it as a short term, there is no cost of equity, but in reality, and I'm for everybody who's in finance and financial services on the call, the implicit cost of equity is 18% plus, right? So one of the questions that a company needs to ask is whether our growth, our performance, our potential is worth that in the long run. That is one of the triggers that you need to evaluate before you go to market. Okay. You also mentioned preparedness. I think that's very important. When you get into the public markets, there is scrutiny from external sources, whether it be regulators, shareholders, broader public. Compliance doesn't remain something like this talked about internally, right? It becomes a part of a company's identity. And it also impacts in terms of volatility about what happens to your company in the long run. So are we prepared for that? So a company needs to assess its own preparedness for going public. It is just not simply a financial decision at one end of the parameter. The third factor that I think in terms of timing is important is the state of the market. I think most people understand that intuitively. Is there buoyancy? It is what we've been seeing for a while. Is there buoyancy? Is there overall market buoyancy? Is it sectoral? Will really depend on what your product is or your service is. And if we are seeing green shoots there, or the bull run that you're seeing now, maybe it's a good time to go to market. And last but not the least is the valuation, right? So when you go there, what is the valuation that you can attract given everything else, given your track record? And as a management person, if that valuation is not adequate, or it's not enough, right, or it doesn't adequately reflect my company's potential, that is not the place to go to in the first place. But if we can answer the question of the need, the strategic objectives, our own preparedness, market readiness, and the valuation, all these five factors being correct, if they are all in sync, then to my mind that's when the company decides to go public.
Okay, no, thanks, Ananya, for that insight. Really helpful to get a context. Maybe I'll possibly move to now Radha. As a market infrastructure player and a regulator, you engage with numerous companies who are aspiring to list. What suggestions would you offer, Radha, in regarding a path to an IPO and readiness assessment as well? For example, what are the steps a company should take to ensure they are prepared for filing the offer document with the regulator?
Radha, I think you're on mute.
Yes.
Radha, you're on
We are
mute.
not able to. Yes.
I'm sorry. So,
Yeah, now audible, Radha. Please go ahead.
thanks, Raghu, for this is a question. This is a very important question, actually, because IPO process is a very complex process, and requires various activities to be coordinated between many and intermediaries, and for a company to be ready with an launch of an IPO. So there are certain major decisions that has to be taken at the time of this process, the initial process only. To just highlight a few things, the company, first of all, there should be an alteration in the memorandum and articles of association of the company. In many cases, what happens is these articles and MOA are there since their incorporation, and they may not have actually the clauses which are required for the companies to go for an IPO. Maybe with the demat clause, the post IPO, there's a buyback clause. And nowadays, there are certain restrictions. If they have a share subscription agreement, if they have private equity into it, then there are quite a few restrictive clauses in the articles, which before the company goes into an IPO or before the draft is put to the regulators, these needs to be amended or modified. These needs to be modified. So this is one alteration. Secondly, it has to increase its authorized capital so that it enables, because generally the companies don't, pre-IPO, they would not want their authorized capital because it's a cost to the company. So the authorized capital needs to be increased at a level where they can see, yeah, this would be enough to cover my issued and paid up capital post the IPO. Then there is what happens is in most of the cases, what we have seen, the pre-IPO, the equity capital is a very small. Whatever comes in, they keep it as the profits are added to the red reserves, and they have enough sufficient reserves, but a very small capital. So that capital needs to be increased, and to be at par, and then to have an optimum level of dilution. So this pre-issue capital should be substantial enough. Then another important thing is in terms of the regulation, in the terms of the SEBI ICTR regulation, the financial statements are to be audited by a peer-reviewed auditor. And failing the top companies, most of the companies will not be having a peer review auditor to audit their accounts as of now or before the IPO. So this peer review auditor, they have to see that if their auditors are not, current auditors are not peer reviewed, they have to make steps to initiate the peer reviewed auditor. Then again, they need to restate the financial statements for a minimum period of 3 years. The restatement would be to the tune of why restatements are required is if there are different accounting policies that have been followed in the past 3 years, then they have to set a common uniform accounting policies that will be followed, restate the accounts to that extent. Then there are some prior period items or audit qualifications. All those effects have to be given in the restated financials to present a proper picture to the investors before the IPO. Then their board needs to be modified, they're reconstituted. There are committees that are to be adopted. Then there is generally it's a 50% that is a constitution of independent and non-independent directors. There is a requirement of a woman director in that. So all these board constitution also needs to be changed. Then the company has to identify what is the require, why do I require funds and how much do I require funds? Because objects of the issue has to be clearly defined in a document. Then there's a legal due diligence that is generally done by an independent law firm, which covers the entire aspects of the company, its business, its promoters. So all that has to be in place. Then there are various other intermediaries involved, like the merchant banker, the registrar, the legal counsel. All those have to be put in place so that once all these things are done, then they come into a platform, they have a kickoff meeting and start the documentation process.
Okay, no, thanks, Radha. I mean, very well elaborated and comprehensive view in terms of the entire process you have taken us through. Now, I'll possibly go to Mandeep. Mandeep, given that companies do face a lot of pressure post listing in terms of valuation, market share, and given the lot of regulations which Radha spoke in terms of pre-listing, do you think, based on your experience, it is actually wise for companies to raise money from these public markets? What's your view and take on it?
Thanks, Raghu. You give me the hard question now. You know? But before I go there, on a lighter side, for IPO readiness, I would add one more step. Take your IPO insurance. And this comes with a full disclosure that we are a company who distribute insurance, right? So it's basically, if people don't know, a DNO doesn't cover, the liability arising out of red herring prospectus declaration. For that, you have to take a specific insurance, which basically covers you for longer period, 6 years, 9 years, kind of this thing. And look at the case of DLF in 2015, they were given about 86 crores of liability because of those misrepresentation. It doesn't cover fraud, but it basically insulate the error and mistakes. So couldn't help but add this in the perspective. Now, very difficult question. Should you go? Should you not go? I mean, if you look from the economic perspective, capital formation is very, very important, and capital formation is helped through this liquidity created by stock exchange. It's very, very important for the economy that people go and list. But when you come to the micro, in terms of what relevant for a particular business, this is a complex question, because it's not only the need of funds, liquidity, as mentioned by Ananya, also the ESOP market that you need to create to motivate people, that also come into picture. But at the same time, you should go and list only when you are ready, naturally ready, not artificially, because naturally, when I say naturally, it means that the sense of accountability, responsibility, governance should come from the value system rather than a compulsion, because you will end up looking at scenarios where you will say that I used to make a particular decision very easily in a short span of time within 2-3 people, and I'm done with it. Now the decision making cycle is longer. I need to take approval not only from the known board members, from unknown investor as well, right? So that kind of maturity require courage, I would say, right? On top of it, whatever you do, you are more transparent in the world, and your competition may look at the disclosures. You maybe have to disclose more than what your competitor does, right? So this is a complex question. It can't be answered simply as that. The only thing I'll say is that please understand, sometimes the behavior get impacted by what's happening in the market, and market may not always be rational, right? In market, you will have whole sort of investors, sometimes short-term investors, sometimes long-term investors. And if a particular noise get louder, then you tend to say that whether you are pleasing, giving return to the investor and that as per their expectation. What happens pre-IPO is that you have some marquee names of a shorter set of investor to hear and meet their expectation. Now it is diverse. You don't even know what they're expecting, so you try to figure out what's your the feedback infrastructure the system is telling you. And if the management compensation get linked to the share price, etc., so you need to be very careful that these are not associated with the short-term price movement. Otherwise, your decision making will go for short-term. So if your organization is mature enough to segregate noise versus feedback, and you don't consider the control system, backend system as a necessary evil, then you are kind of in a position where you can say that, okay, I'm ready to put in money to first set up those backbone systems, mature the organization where the decision making can be up to a standard, and then keep doing it. For example, you need to invest quite a lot in compliance, legal, as well as internal control systems. You would have to ERP as your business, but now you need to more accurate, reliable information, right? So the whole business is many people. So my suggestion is that look at your industry, look at your business, matured, not matured. Don't only go by providing the liquidity option to the investors, because another tricky question, and a lot of the startups, etc. I'll not say startup, but the recently listed players would face this dilemma is that how to price the IPO. If you price above the natural value of the business, you will be always under pressure to deliver more and more, because anybody coming and investing will be expecting some IRR on that particular investment amount. If you price lower, then the current existing investors are not getting the work, and there could be conflict of interest and with the advisors, etc., who kind of take pride in saying that we got you more value than what you expected, right? So it becomes a very tricky situation to price it, but need to be done very, very carefully.
No, I think that thanks for that, and I completely agree with you that pricing is quite important, and your insight on insurance is also quite a good. I think a lot of people will look at it. And moving to Sharad, being a guy who has helped a lot of companies and taking them to IPO path. Sharad, from your perspective, what are the few common long lead items and areas to focus on as a company gets into this listing journey?
Sure, Raghu. Thanks for that question. And I think a good part of the response of this question, I think, has been covered by Ananya, Radhika, and Mandeep. But I'll cover some of the key areas, And I think the first, which I would start with, is really what Ananya started with, is, what are really the objects of the issue, which means why are you doing the IPO? One of the longest lead items, which I always tell companies when I start engaging with them, and as they start thinking of their IPO journey, is why do you need capital? Why are you raising? Okay. And the reason why it's important is also how you will gather investor interest. Because when an investor is coming to you and when let's say you're doing a roadshow, everybody is interested to understand why do you need money, to also understand your vision. Okay. And that really drives a very, very big part of decision-making process in the journey. The second key area, as you think about going public, is getting your capital structure right. Okay. Now, as you started earlier in the session, India today is obviously the hottest market today, I would say, from a capital market perspective. We keep reading every day a lot of companies wanting to flip structures, make India the parent company. But flipping structures, is a good term, is like the it word today, but not an easy task, long lead in itself. So to get all your investors, especially in a private equity setup, first aligned to move to India, because obviously one is flipping, second is the underlying tax regime and other considerations from an Indian market perspective, with all investors have to be on the same page. That again is a very long lead item, which takes a good amount of time for all investors to come together and agree. So the second key area. The third key area, as the first two are addressed by an organization, which can be done obviously in parallel, is really again the definition from a SEBI standpoint of who's going to be defined as a promoter in the offer document and the promoter group. Okay, that again becomes a very, very key factor, especially in organizations where a private equity may be having a majority stake at times, and thus the whole definition and determination of promoter and promoter groups becomes all the more difficult and challenging at times to deal with, and what changes you may require to go through that. The fourth key area from a long lead perspective is how to build your story, because whenever you are planning to go public, the most important aspect is how you're going to sell yourself. Okay. And how you're going to sell yourself, to the point Mandeep made earlier, is a lot that's dependent on how mature you have reached today to be able to tell your story and build on it with vision. Okay. So that becomes another important key area to focus on. The second last I would cover here, and not the least, is what Radha spoke about at length, is really ensuring how you are meeting the financial reporting requirements. Okay, one is obviously last 3 years restated financial statements, uniformity of policies, but one of the biggest challenges or changes which companies have to really deal with is getting used to a quarterly or an interim reporting rigor. And when you look at the time of IPO from a SEBI ICDR perspective, any piece of financial information in the document has to be audited. Thus, if you are beyond your 135/180 days, from your year end, your financials are stale. And thus the latest interim period, or as we call the stub period, needs to go in, which needs to be audited as well. So that again becomes an important consideration in the journey as you start thinking as to when I want to go public, to say which periods I may end up including, and thus plan for it. Okay. And last but not the least, for me is obviously an area where a lot of times companies stumble upon issues much later in the game, which is, are there any significant legal matters? Are there any matters where some approvals are pending, which can really change the way you're telling your story, which can really impair in a big way even your ability to file at times. I have had instances working with companies where, we are getting very close to filing, and in the legal due diligence, like what, Radha was talking about, something crops up which is 15 years old. Company did not comply with some ROC filing 15 years old, for which you don't even know what the non-compliance was in detail. Nobody is available in the company today to even tell you what happened, and you have to deal with it. So I think those are, few of the key long lead items which we typically, work with organizations to help them, get ahead of the curve to deal with.
Well, thanks, Sharad. I think that was quite useful. Maybe I'll now move back to Ananya. Given that we spoke quite a bit in terms of the listing process, etc. Post listing, an entity needs to take care of a lot of regulatory requirements, and these days technology is the buzzword. And uh, in your own experience, can you share with us, Ananya, as to how we can leverage technology to ensure that companies can stay relevant and also compliant in the entire process, and ensure adherence to the ever-changing environment currently we are in?
Yeah, so that's a particularly favorite question of mine in terms of the technology required to remain compliant. So we have spoken, I think in the panel has referred to a lot of questions on the cost of compliance that's going up for all the right reasons, right? There is greater emphasis on governance, on corporate governance, on integrity, on transparency, right? And it shows up in the various reports, queries, information, disclosures that are required by a listed company. Now, what I've seen is, but the enterprise architecture that we have in most organizations is not up to the mark, especially when you start small. Everything is at your fingertips, and the 200 people who are working with you, maybe the 50 people who are working with you, and you head everything. But as the company scales, and it will scale just pre-listing or post-listing, things are not the same, and most companies don't invest in a very robust backbone of their architecture. On top of that, so what I've seen is many companies still rely on Excel, right? That's the favorite. If anybody asks me what's the technology platform that people use, I always say it's Excel. It comes with its own hassles. Needless to say, I think everybody's smiling, and we all know this. Yeah, there's a huge propensity for errors. There are no audit trails. The editability is huge, and something that's a little bit concerning in terms of regulatory filings, etc. Right, and the implications of these regulatory filings are also very onerous. So the ideal way for people to do would be to look at a technology platform, right? Now I'll divide the platform also into two parts. One, what is available in the market today, and when we've done scouting across various companies, right? My current role and my prior roles as well. The platforms usually are very robust in giving us tracking and alerts, right? It is telling us to be compliant on time, and there's an early warning signal and things like that. I think there are a few tools in the market, all approximately the same, and then they have a tracker and they have a confirmation bias type of thing. So it's there, and I'm not saying that that is not important. I think that's fairly important. Others, you have a person managing a calendar, so that's not good. But what is not being focused on is the platform for automated data reporting, right? In an environment where apps etc are like really user friendly, we don't have automated data reporting tools that should make reporting a breeze, if not a joy. And we have not invested enough, right? So I think there are no, the most of the products in the market are large sized, doesn't work. There's no nuance for the business, and each business has its individuality. I come from a company where we have multiple lines of business, so it gets even more complicated. So we rely on customized data warehouse type of solutions to build an in-house platform to work with this. And these platforms, there are two things. One is data management. I think it's not the tech part that's actually the complexity. The problem is data management and the rigor around that. And the second thing is the scalability of the solution. Because the reports will change, the requirement will change. That is a given. And if you work backwards from it and you have a modular type of a system, that is what will work well in the long run. Okay. But my advice to companies would be to invest in this, decide on a make or buy. And in many cases, I have seen the makes work better because it is very specific to you. The last part on technology, which I have an open question, and I'm sure the panelists will also, others may also have a view on this. 80% of compliance requirements is rule driven, standardized, and that's what I'm talking about so far. 20% of this is inherently judgment based or subjective. Okay. Until the much wanted AI comes into place and is equipped enough to deal with the complexities of our regulatory landscape, there is going to be a people element at the core at the end. It's 20% of the type of reporting, but it is 80% in terms of criticality, right? So technology, if I have to paraphrase, very important for standard reporting. But I think a listed company needs to be aware that there is a huge amount of subjectiveness in the data that is sometimes required, and one needs to be ready for it. So where people instead of technology become key and domain expertise becomes really the ask.
Okay, thanks for that. I think you are right. Investing in technology and right technology is really needed to ensure someone really meets up with all this thing. And yeah, now Radha, a question for you. We heard from Ananya and Sharad in terms of the various tasks a company needs to take care before they file the document with the regulator. Now the regulator must be inundated with a host of prospectus and other documents from the corporates seeking to list in the exchange. Can you maybe throw some insights in terms of what happens behind the scenes? Because we don't know what happens after these documents are being filed with the regulators. For instance, what considerations go into the approving these documents, and what should companies actually ensure that they meet all the regulatory requirements on a go-forward basis as well? So Radha, you are on mute again. Sorry, you may have to unmute.
Sorry, I'm so sorry. Yeah, so generally what happens is once a document has been filed on the stock exchange, draft document on the stock exchange and the SEBI website, everybody is relaxed for a moment. Now my 50% of the job is over. Now we don't have to do anything. So now starts the regulators and the stock exchanges work. So once the draft document is filed, then both the exchanges and SEBI, of course, they have a procedure to be followed. Generally, the documents are filed along with a checklist. A document is filed separately and a checklist of other required undertakings and resolutions and everything that a particular stock exchange required. It's a standard checklist. So along with the document, all those things are also filed. So then starts they start reviewing the document. The SEBI reviews the document, the stock exchanges review the document, and then we see whether they fall into the eligibility criteria, whether the compliance requirements are met, whether the board is appropriate, corporate governance is there. All that is seen from the stock exchange. It is, everybody sees this individually. So it's not that what we see, the other stock exchange may not see, or what SEBI may not see. It's individually, everybody sees it. Once that is done, then what we do is we circulate in the exchange. Once the team reviews it, we give it for a committee approval. And there sometimes the issuer and the merchant bankers are called for an interview to just understand what the company is about. And once the personal hearing is done, we have a committee meeting again, and then the approval is given. So what happens is, first, the approvals of the stock exchanges are given, and there is a time limit set of 30 days wherein which we have to give, both the stock exchanges have to give the approvals, and post which SEBI, which is already reviewing the documents and calling for all the information which is required. And certain times what happens is, post the information that is required, if any addendums have to be issued or for the necessary modifications or changes, so all those addendums are also issued on the website of the company. The draft actually is kept for public observations also. So if any public also wants to comment on this, all those comments are also taken into consideration. Once in principle approvals are received from the stock exchanges and SEBI, that comes the next step. Then in the meantime, what the company does is goes and markets the issue to the investors and gets a sort of a valuation feedback. And relatively then the pricing is fixed. Then the company updates the document, that's called a UDRHP, and refiles it with the stock exchanges. Updations is all that wherever the amendments have been made, wherever more clarifications have been sought, all the updations have been done and refiled. Then for the refile draft, updating draft prospectus, again there is a sort of approval is given, which may not be in writing. That's verbal approval has been given, and then the company goes and files the document with the registrar of companies. So once they file with the registrar of company, the issue dates are declared, and then the pricing is declared, and the issue is opened and closed. A minimum period of 3 days, and with a maximum period of 10 days. So then after the closing, there is a listing approval, listing stage. So once the issue suppose closes on the T date. So the basis of allotment is done within T+1 day. The next day the allotment is done. The second day the refunds are done. Whoever are not allotted, the refund goes to that. And the third day the company is listed. So this is the general procedure. Yeah.
Oh, no, thanks, Radha. In fact, you are right. Every company I've seen after filing the DRHP has a great sign of relief, and they're quite happy about it. And they're not, to be honest, bothered what happens behind the scenes after that. Maybe I'll change tracks over to Mandeep. Mandeep, we are seeing a good traction as we see in India in terms of the listings happening. Given your background, what are the learnings you may want to share with the participants in terms of
Lost you, Raghu.
Yeah, I think we lost Raghu.
Raghu, you're not audible.
Lost you.
Raghu, we can't hear you.
Yeah, Mandeep?
Yeah.
So we lost you, Raghu.
We can hear you now.
Oh, okay. You lost me, Mandeep. Should I repeat?
It will be helpful.
Oh, sorry. No, what I was just checking with you is that given that all these companies are in the process of listing and we have participants here keen to listen to your experience, what would be your advice given your background regarding the aspects companies need to keep in mind in terms of governance, building up a culture, and also any other critical aspects which they need to take forward as they go into the public markets?
I think a lot has been said, and in a way, it was like telling everyone, the people who are trying to go IPO route in terms of what they need to do. In the process of that preparation, you build certain capabilities, right? I'll not repeat, but just for the sake of summarizing it, investing backend system, compliance system, accounting and reporting system are few things that is required in any case. What I'll focus is on that post-listing, etc. What do you go back and see in terms of what capabilities you should have built apart from the capability that you acquired in the application process, right? See, what happens is that a new set of regulator comes in your life, right, which was not there earlier. Then there are stewards like the exchanges, etc. There is a process, etc., which has been mentioned. So your ability to deal with a regulator in a transparent manner, in a proactive manner, is something where most of people struggle because it's a matter of looking at the law and understanding what it want to say rather than saying that this says this much only. And there could be situation specifically in our country which says basically do whatever minimum is required, right? Rather than saying what right is required, or sometimes it's required to put yourself up for scrutiny, which is a very difficult task to do. So that ability to figure out what does it mean and what is minimum standards and what are good standards require you to have a very good sense of law, market, as well as a network of people who are already doing this for many number of years, right? So that network come into play when you are actually into it, and then you start figuring out what need to be done. If you start building it beforehand, it is really helpful. The other aspect is the risk management piece. And when I say risk management, this is information security included in the risk management practice. It start with when you start looking at DRHP, etc., you start to put down the risk, but then you tend to stop, saying that I've listed all the risks, what are the mitigants, etc., but realize that this is going to be your life going forward. And there has to be a committee of, risk management committee, etc., and that the information security in any case as you put more and more system get exposed more and more to the digital network. This is very important and emerging ask from the company. The sensitization of management as well as people in terms of flow of critical information. For example, there is a requirement to maintain a SSD or structural database, which will be maintained by, let's say, a company secretary or a compliance officer, but the information doesn't reach to him. Then how will he manage that particular piece of information? Then UPSI, identifying that this can be UPSI, and when I deal with a consultant, when I deal with a vendor or somebody, so am I exposing? So these kind of things become important and are new things which you have not dealt before. This requires investment of time, energy, as well as focus. Now, businesses are generally focused on growth and profitability. This is an ask of investors, and everybody is running behind those two parameters, which are not easy to achieve and balance. So you need to figure out a leader or two leaders or three leaders who will be focusing on setting up that system. Generally, CFOs or a compliance officer or somebody will be given the task, but at the same time that they need to be empowered to carry out that change in the organization. Another one comes to my mind is documentation versus bureaucracy debate. The moment you ask somebody to put a reason behind a particular decision, they say that this is bureaucracy, but at the same time, these very documents are the documents which will be reviewed, audited, and saves somebody in terms of what happened, whether this is an intent or was it a mistake. How will you prove it? So these kind of internal conflict happen. Rallying that organization and the culture saying that this is required, and striking that balance between these needs is an art rather than, I would say, a science. That need to be done. But this all comes from tone at the top. That need to be set right. And that's where I say that go in IPO when the tone at the top is right. Otherwise, you do something under pressure from investor or somebody, but you will bound to face struggle in the later stages. The last I can say is that your communication strategy, the public face. Earlier, even if you're in B2B or B2C kind of a business, you are good not speaking that much, not telling that story, just tell it to 4-5 investors, get the money. But now you need to be a good storyteller. When I say story, I'm not saying that the fiction. I'm saying it more should be a factful story. So your ability to differentiate fact from the gut feeling, or rather the spur of the moment kind of stories that keep happening is very important. All in all, it requires great deal of maturity to deal with these kind of issues, and great deal you can learn from the network, and one need to invest in that.
Thanks, Mandeep. And continuing the same conversation thread through to Sharad, as a consultant, when you see from an outside perspective, what are the challenges which you see the companies encounter post listing, and how can they set up good processes and systems well in advance to ensure that some of these can be tackled far better?
So thanks for that, Raghu, and thanks a ton, Mandeep, for that, for that level of detail which you spoke about, which is obviously very, very practical and very relevant. So, I always tell companies from a post-listing perspective, whether it's India or anywhere in the world, and I'll use this term in Hindi, we always call it quarter se quarter tak, you know. So life is really one quarter to the next quarter. So it never really ends. From that perspective, you always have to be on your toes. And for that, you always need to be ready. And the most important thing you need to really have to be able to be ready and be focusing on the right things is having your bolts and nuts in place. Okay. And from that standpoint, sorry, Raghu, can you hear me?
Yes.
Yes.
Yes, sir.
Sorry, I think the screen froze. Sorry. So I think from that standpoint, one of the most important things when I look at and I break this again in areas is one, I would say, financial reporting. So clearly, whether it's a financial reporting system, whether it's the inputs to the system, which really help you close on time and close on time in an accurate manner. Okay. So when we look at, a quarterly reporting scenario in India, you can have a quarterly review done by an auditor, you can have a quarterly audit done by an auditor. But as a listed company, whether you are getting a review or an audit done, from your standpoint, your numbers for the quarter are sacrosanct. That's what you're going to the market with, to the public with. So how comfortable do you feel with those numbers? And especially when we look at the Indian market, and again, depending on the type of sector in which you are, let's say if you look at technology companies in India, there is always this, this race, who's going to report first, after the quarter. Am I going to report in 8 days? I'm going to report in 12 days and 13 days. Okay. Not the trend in international markets, but India clearly, it's a very, very key trend. And a lot of times investors are expecting that it's become a norm, to see that. And thus from that perspective, financial reporting clearly very important. Okay. The second key area when you think about financial reporting is also obviously the underlying internal controls in the environment. Okay. Because till the time you don't have the right internal controls, you're not going to get the right output. So you don't want garbage in, garbage out. You obviously want good data to be coming in, timely data to be coming in, and that is what you go out with. Okay. So focus on internal controls, again, very important. One other very important thing in this area which changes pre and post IPO is really, the importance of IT in the setup and the importance of IT controls. Okay. In today's environment, depending on the nature of the sector in which you operate, irrespective of that, IT is always going to be a key component of how, how really we live and breathe. Okay. So that again, key focus area. And fourth, last but not the least, is something which Ananya was talking about earlier and Mandeep touched upon as well, is really your underlying compliance monitoring process and controls you put in place. Because as soon as you are listed, it's always good to be listed, but the challenge which comes with it is you are expected to be a listed company and ready to be a listed company from day zero. The moment you ring the bell, you have to be ready. Okay. And thus from that perspective, compliance becomes very important, because when we look at SEBI regulations today, especially regulations around material events reporting, categories of events, and the minutes or hours you have to report them, okay, to the market, that is a very important consideration for you, not only to say how I'm going to report, but more important is how I'm going to become aware that a particular event took place. Because if you talk about results, I know a board meeting happened. I have to declare in 30 minutes. But when you talk about many other material events which do qualify in that definition, it's very important to have the right mechanism within the organization and the right level of sensitivity within the respective people in the organization to report it through the channels for people to be responsive and make the disclosure. Because end of the day, we do have two CFOs in this forum with us today. Their life for that matter is always on the hook when you think about, material events, to say along with the compliance officer, is the reporting going out on time or not? Is it going out in the right manner, drafted with the right words so that the right message is being communicated? So I think those from my perspective would be, key areas or challenges which companies should be wary of and deal with them in advance.
Oh, thanks, Sharad. Quarter say, quarter tak. Okay.
Yeah.
So, Ananya, from your perspective, seeing this role as a CFO for many years, what do you think? How can companies enhance shareholder value and also ensure that they maintain transparency, foster innovation, and also ensure long-term growth? Right. That's also quite important for every companies. But they should also keep in mind shareholders' interests. How does one really manage all of this in the current environment?
Yeah, so this is one of the balancing acts that one needs to do. And I'd start with an overall theme of culture. I think Mandeep has mentioned it quite a few times. You have to be ready to be a listed company. It is a different world. Okay. So if I try to highlight a few things which I have, and I've seen companies that are in the have private equity and then listed companies, and I've seen both of them at close quarters. What are the changes, right? For example, I think relisting companies look for growth. It's top line driven. Okay. And sometimes to the exclusion of everything else, right? Solely top line driven. Uh, as you get into a listed company post listing, and actually pre-listing preparedness, we already spoke about that. Your enterprise functions need to be very tough. You need to really staff them well. We spoke about empowerment. I think Mandeep spoke about that also, right? Empowerment is required. You need really strong people at the helm, whether you look at the compliance functions, the CFO functions. I'd also talk about, I think you mentioned communications, IR, PR functions. They are completely different in listed companies. Okay. And we are not built for it. And when you're transitioning, that journey gets really tough, right? So questions on making the sale happen or the new line of business is not really very welcome. So the culture of being a little more accepting of that, of understanding the norms that you work towards or within, is very, very important, right? So I think org structure, I think, is something we have spent in our company some time on defining. Okay, the HR part of it, but it is extremely key. The other one, which may be applicable to a smaller set of businesses, but depends if you have a multi-line, multi-product business, is the legal entity licensing structure. Right now, there are walls between, say, two lines of business, unlike in a bank. And I've been in a bank where you can do multiple lines of business within one legal entity. The legal entity structure is something that needs to be taken care of. There is enough, I think, current news on the number of subsidiaries some of the larger groups have. But I don't know whether it is a race to a higher number or a lower number. We've been going the lower number. We take pride in reducing the number of entities and sticking to the knitting in each one of those legal entities and operating in them. And you have to learn to operate in them, which is also unique. Otherwise, the bureaucracy question comes up, ki, "Arey, theek hai, why are you doing it here? And why do we have to wait to open a legal entity? Why do we have to wait for the license?" Right? I think risk management becomes very key culturally. It is all omnipresent. People, the operational risk or technology risk is more understood. It is more tangible and given attention to. Listed companies, I see, we struggle to define the intangibles, which is the uncontrollables, reputation risk. That's one of the biggest things that impact a listed company, primarily because it is almost everything is disclosed. It is public information. It not only affects your shareholder and the shareholder value, it has cascading domino effect on other stakeholders in the system, right? Your lenders, your rating agencies, regulators, tax authorities. If nothing else, there is a spate of queries which will keep you up for days at end, right? Just to get the narrative correctly done or explanation of a specific transaction. So I think risk management on reputation is difficult. In my experience, risk management, the other one, which is half reputational, half people, is people and retention of talent, right? An exodus of people or key personnel is also not seen as well. So retirement planning, rotation, mobility, things that are very internal facing in a non-listed company become very public facing, and you end up answering questions about why a person has moved roles, and is there some crisis that we're not aware of. So it reaches out into that space. So culturally, we have to be looking at risk management for the intangibles, which is a little bit of different. And last, I think on your quarter tak, I agree, we live by the quarter. But what I've learned in my experience is a listed company needs bifocal planning. You need to be planning for the next quarter. You also need to be planning for the next 5 years simultaneously, right? So at any point, the skill to or the muscle to develop for a company is a macro 5-year plan, a micro next quarter plan. Okay. Near term horizon, higher term horizon. You work with a lot of probabilities, but the point is that skill is not inherently taught anywhere, right? For example, capital allocation to the businesses, not really understood. It's not a subject, at least it wasn't when I was studying, but it's something you learn on the job. And you see, if you have to maximize shareholder value, you're really talking about capital allocation at the end of the day. And how, and quarterly or no period is often enough. It is something that is intrinsic to you. What are the metrics you're going to base your evaluation on, right? But unless there is a framework that operates, unless these businesses have the time to grow, shareholder value tends to get eroded over time. And it may not show up in the next quarter results. It may not show up in your profitability. One of the things we have a lot of angst with is profit important, is earnings important, is equity important? And I'm not choosing, I'm just saying I want all of them. But then if there are nuances to be done, how do you balance an accounting standard requirement with a disclosure requirement? You know, we are also in a country where right now all the accounting standards are not aligned. We are partly on Ind AS, partly in IGAP, and partly in both in some industries, right? So I think the culture of doing this, you know, zoom in, zoom out, handling multiple things at the same time, sometimes conflicting, sometimes they may appear conflicting, but the ability to handle that is an intrinsic part of the culture. And shareholder value arises from that. Value arises from the choices you make, the strategies you choose to do, and the more importantly, in my mind, the strategy you choose not to do, right? So I think that is the cornerstone of shareholder value creation, and it is an art with a little bit of science behind it.
No, thank you. And I love your idea of bifocal planning. I mean, that really would give a lot of focus to the company to ensure they are able to see both the short-term and the long-term goal together in a very far more mature way. And
Right.
on a lighter note, to cover your reputation risk, I'm sure Mandeep will have a policy for it.
I wish I'll reach out to Mandeep after this.
Well, I'll start publishing phone number of my BD team.
Okay, so in fact, Sharad touched upon this topic when he was listing out the key factors on promoter and promoter group being quite relevant and important. And Radha, on that topic, once a promoter, always a promoter, right? And therefore, in the listing process, role and definition of promoter is very critical. Could you elaborate from your perspective the restrictions and rules surrounding how one goes about defining a promoter? What are the responsibilities of these promoters defined post the listing period as well? That would possibly help a lot of participants.
Yeah, you rightly said, once a promoter, always a promoter, because promoter plays a very crucial role, and they assume various responsibilities and oversee the entire compliances, maintaining transparencies. They are supposed to protect the shareholders' interest. So a lot of responsibility is up to them. So the identification becomes a very important decision to be taken before the company goes to public. So in terms of the SEBI ICDR regulation, there is a term promoter defined, who has, generally what is that in the annual accounts, they determine so and such as a promoter. So whoever has been named as that, or they may not be necessarily named in the document, in the offer document as a promoter. So so it's more of a who is now being named in the offer document as a promoter, or who has a control over the affairs of the company, or under whose direction the board takes a decision. Okay, so these are the broad things of who the promoter can be. Now, once the promoter is decided, is identified, the further step is to identify the promoter group, because that also plays a very important role in the whole this capital shareholding pattern and everything of post the listing. So when I say I am a promoter, so my as per the SEBI regulations, my immediate relatives, that is the spouse, the parent, my brother, my sister, or any of my spouse's such immediate relatives, they automatically come into the promoter group. Okay, so then if I am a body corporate, so my holding company comes into it, my subsidiary company comes into it, then any company, there is a restriction, whether there is a this of 20%, that is a holding. If I hold more than 20% in any company, or if the other company holds more than 20% in our company, so all that comes into the promoter group. So when you're defining a promoter, you have to be very careful that you may have to be including all these people also, or entities also, in the promoter group. So if you want them to be included, then only you have the main person as the promoter to be there. So what happens is, once the promoter has been identified, the promoter group has been identified, there comes again the lock-in. You're supposed, once the post-issue capital is done, then you have a 20% lock-in. The promoter shares are to be locked in. So here comes the core promoter. I'm not talking about the promoter group. So the core who are the promoters, that 20% of their post-issue holding, whatever their holding is, needs to be locked in for a period of 18 months. The entire pre-issue, the entire holding of the promoter group is locked in anyway, which ways other than the 20% is locked in for a period of 6 months. So this again is a factor which is there for identifying, if I am not ready to lock in my shares for a period of 18 months, then I am not supposed to, I wouldn't want it to be named as a promoter. So then there are certain disclosures that needs to be done. If I'm a post-listing, if I'm a promoter, so there are yearly disclosures that needs to be done. There are disclosures regarding any change in my holding about 2% or so. This is as per the SEBI takeover regulation. These disclosures needs to be done. Then as a promoter, or as a promoter and promoter group, if they hold more than 25% in the company, then they cannot go beyond 5% in a year. So there's a creeping acquisition limits are there on a promoter and promoter group. Okay, and so then again, therein, once are defined as a promoter, if you want to reclassify that person as a non-promoter, there again, it's not a simple process. You need to have shareholders' approval for it. There are certain restrictions. Only if you hold less than 10% can you be reclassified. So all those factors needs to be considered. And there are too many responsibilities. There are if the promoter is there are civil liability for misstatement in any statement in the offer document. If it's a misstatement or is a non-disclosure of material information, there are civil and other criminal liabilities on a promoter. So in view of all the responsibilities and restrictions levied, a very careful consideration is to be made at the time when you actually identify the promoter of a listed company. And generally, so therefore, the legal counsel, the merchant banker is involved throughout this process to help the company identify who they want to name as a promoter in the document.
Okay. Well, thanks, Radha, for that. And promoters are also quite keen to continue in many cases, and are always wanting to have a seat in the board. And and with that, possibly, Mandeep, from your perspective, how do you think, and how do you think the composition of a board, an audit committee, should be looked upon? Given that you will have promoters continuing, you may need to have independent directors coming into the board. How do you look at it? What do you suggest should be an ideal composition, or what should go in people's mind before they decide in terms of how they should constitute their entire committee?
So, Raghu, recently, CII Financial Reporting Group, which I was part of, we did a report on SEBI regulation compliance, syncing up with OECD principles, as well as looking at a few recommendations on LODR, which I think has been submitted to SEBI. Shobit has more information on that. What we did is that we started to look at these kind of issues because LODR has a part code for the corporate governance built into this. To us, largely the structure has been defined, and it's a very good structure right now. So what you have is an independent director. Some committee also, it has been specified in terms of how the subcommittee should be structured. For example, for audit committee, the chairperson should be independent, as well as should have experience from the field of finance. Looks okay. The two comments I have is the risk committee right now is scheduled to meet after 6 months. So the minimum requirement or the gap is about 180 days. So that should be reduced, because now this also has information security dimension to it, which cannot be deferred till 6 months, right? Should like be another committee. The lesser focus, I think, and the more focus can be given to NRC, because this is also some funny changes happen. For example, if there's a promoter, founder, whatever you call it, earlier his remuneration is, convincing 2-3 people and taking an approval. Now you will go to NRC, then you will go to shareholders, then you will look at what proxy firms are saying, right? So it becomes a very complicated process. At the same time, you have dimension of ESOP, etc. So this NRC, if we can look at bringing in a person as a chair who has experience of dealing with this complex problems, as well as in a highly governed or regulated environment, I think that will add value to organization. Rest all seems okay right now. On independent directors, there's a big debate in terms of who is really independent, right? And then role, responsibility. The couple of issues which the all listed entities as well as regulators, to my understanding, is deliberating that these issues are: one is promoter, which has been talked about. Second big is related party transactions, ability to identify and handle them. Those become critical, and that's where the board structure and real independence come into picture, because these are the guys who will guide people to do or identify and follow a certain process, right? And the third debate, which is not settled as yet, is response on the rumors, market rumors, right? So these three large bucket is something where I think we will see some resolution. The new committee, in terms of which nobody would have been experienced before, would be CSR or BRSR committee. It generally, before listing, you manage it in a very informal way. There is a CSR obligation, but now you have a committee, and then these committees get evaluated as well, right? So, so couple of changes in the corporate structure that happens, and there's no right or wrong answer here. It's just that it depends upon the intent and with which you are trying to set up the governance structure in the organization.
Thanks, Mandeep. Thank you. And I think we are 15 minutes away.
Just to add, Raghu, sorry.
Yeah, please go ahead, Mandeep.
So just also what happens is that, let's say your business is a particular domain, so you try to get directors. You try to get the expertise by way of directors, which can bring in outside in perspective while you look at independent directors. That's also a trend that I'm seeing, that people try to filter out the universe of independent directors and try to hire where they can get some added advantage in their business.
Okay. No, thanks, Mandeep, for that. And I think choosing the board and the right members for the board with the right set of skill sets is quite important for success of any organization as they go through this listing process, right? And conscious of time, we just have 15 more minutes. So possibly what I will request each of the panel members here to maybe take about 2 minutes to summarize from their perspective as we're coming to the end of this session. Well, we have heard a lot. I think it has been very enriching for me, at least, to hear various perspectives from CFOs, regulator, and from a consultant as well. So maybe start with you, Ananya. Some closing remarks from your end in terms of what should be the key takeaways for the participants in this webinar.
Yeah, so I without repeating too much, and I think Mandeep had a great set of points on the board. I think just a small addition to that is also how one engages with the board. It's pretty much that culture tone from the top that we've been speaking about, right? What do we also take to the board is a question that becomes more and more important. There is a spirit of the law that says everything. One also needs to be conscious of the fact that independent directors have a lot of onerous responsibilities. Also, they are on multiple boards, time, bandwidth, right? We use a framework or like a ACI framework, which is an approve, consult, inform, information due at all points of time, consultation on key matters, and approvals maybe not as much except for statutory stuff, but I think that engagement or the line or the frameworks that we choose are very important. But in summary, I think if I would leave the attendees with one thing is, there is a lot of unanimous decision, views on what this journey is. It is actually the financing part is the last part of it. It is an outcome after you're ready with everything, right? It should be a natural outcome of who you are, what do you want to be, are you ready? The softer questions, and they are the tougher questions, believe me, because there are no good answers that are easy. You keep balancing it. If you are ready mentally, and if you're ready to go onto the treadmill as well, it's a bit of a treadmill, and there is no walking away from that. If that is what you're signing up for, then being in the public market space is also very exciting and exhilarating, I must say. I've been in non-public listed companies as well, and I know what excitement this place brings, but the risk also remains high. So this is a choice that you make as you go to the market, but like really financing is the is the last end of the chain, unlike what we started off this panel discussion with saying it's the first thing that you choose to do or you define. Yeah. And readiness is the mantra, and if we are okay with it, then it's a glorious journey.
Thanks, and I really appreciate it. And Radha, some closing remarks from your end as well. You're on mute.
Just one thing I would like to say. Listing is just the beginning. So once you're listed, you have to be more transparent. We need companies to have a good corporate governance and see the part of the growth, because we need investors who can make money out of your company, the growth of your company. So that's what it is expected.
Thank you. Okay. Mandeep, some words from you as well.
You are on mute.
Yeah, sorry. I think the biggest advantage of listing is not the funding, is the institutionalization of business, which means the business can be built to last. And that's where, a lot of effort required to make a business which goes on for numbers of years and keep creating value for shareholders. And there are pretty good number of examples there. There's a lot of focus and information, etc., is available for mechanical steps that need to be done to get listed, and even after that, including system processes, the steps to be followed, forms to be filled. Probably it will be a good idea to figure out how do we come out with a cultural guide or cultural pathway to enable businesses to move where they should be in some time. Now, maybe the consultants or maybe Shobit, we can look at in CII in terms of, can we create some case studies or cultural pathway for listing. That kind of guidebook, which is just an indication in terms of what you need to do or how you can solve few things, can be helpful.
Sure, sir. Very valuable suggestion. We'll take it further with your guidance.
And Sharad, some concluding remarks from your end as well, please.
Thanks for that, Raghu. So I think from my perspective, the concluded remarks would be, really consistent with what Ananya, Radha, and Mandeep said. For me, I think whatever I tell my clients when I engage with them is always plan well in advance. A lot of companies, I think the trap which they fall into is they look at IPO at times as a project. Say, okay, this is a 6-month project for me. What you need to realize is this is not a project. It's actually a way of life. It has to be business as usual, which means don't look at it only as a project to say, I'm going to do this and then I'll see next what happens after I ring the bell. When you decide that you want to ring the bell, you better be ready that I am a public company from today. And that's what I always tell companies I engage with, that start operating as a public company before becoming a public company. And that will always hold you good, as you go forward.
Yeah, that's why I said, Sharad, this thing is just the beginning, actually.
Yeah.
I think a nice way of putting it, Sharad. And thanks a lot. A lot of good takeaways from me personally on this session, engaging with all of you. I like the way Ananya put across that there is a joy to the entire process. Of course, there is a risk behind everything. One has to measure between the joy and risk as one takes it. And yeah, listing is just a beginning, and a journey is waited along. And I think one should institutionalize a lot of things, plan quite well. And as long as someone has a good sustainable business, I think it's all up to glory to take it forward. And I think a fantastic inputs from all of you. Thank you so much. Thanks Ananya, thanks Radha, thanks Mandeep, and thank you Sharad for a very insightful conversation. Really appreciate it, and I loved it. Over to you, Shobit.
Well, thank you everybody for such an engaging discussion, and I believe the points emanating, the way you have put it, articulated it, it's going a long way in helping the CII members who are not yet listed and looking at that journey. So each one of you, Mandeep Sir, Ananya ji, Radha, Sharad, and many thanks to you, Raghu, for putting it all together. And so nice of you. We look forward to have another engaging session.
Anytime. Thank you for having us on. And
Thank you. Thank you,
great
everybody.
to listen to all my co-panelists. Thank you.
Thank you. Thank you, everyone.
We can conclude this session. Yeah. Thank you so much.
Thank
Bye-bye.
you. Bye.
Thank you, everybody, and have a good evening.
Thank you.